Hey, welcome to the weekend live stream. And as I'm sure most people know, I am streaming while the NFL is playing football. We've had a couple of really good games being played. The Bills are hosting the Cincinnati Bengals. It is snowing, the field's covered. These guys, it's a high scoring game too, which is incredible. And then the Baltimore Ravens are hosting the Pittsburgh Steelers. Really two good games, but I'm not going to talk a whole lot about football. I'm going to talk about stocks. I'm going to get my head in the game and talk about stocks. Over the past week, we had a rising stock market for the month of December. The S&P went up 0.54%. And that was good. It was a little choppy here or there. Looks like early in the week, it was a little choppy. We got to the 4th, which was Thursday, and we had a nice rise. What else is going on is that I like to look at crypto because the Bitcoin, if it's heading higher, that's a good thing for stocks, growth stocks. That usually means investors want to take on some risk and want to bid up those tech stocks, biotech stocks, small caps, stuff that's a little riskier, but has real potential of paying off in the long run. So Bitcoin's rising. That's good. So we have a market that did okay for the week. And we have the Federal Reserve is going to is going to meet on Wednesday, make a decision on interest rates. Just about most people, like 85% of people that are willing to guess on what they're going to do, they expect the Federal Reserve is going to reduce interest rates by 25 basis points. And that should happen this week, and we're going to be fine. I don't think it's going to cause a rally in the stock market. If they go 50 basis points, that would cause a rally in the market, depending. The market may be nervous that, whoa, does that mean a recession's coming? So it might backfire. So if they just come out with a 25 basis point cut, I think we're going to be fine. The market last week, there was some interesting stuff happening. Here's the 1 week heat map. This is looking at 1 week. Nvidia. There was volatility. I bought some shares, I think on Monday or Tuesday, and they rallied from there. So Nvidia's seen a little bit of volatility. Nvidia sold off for the most part during the month of November. The pricing on Nvidia really came down. Broadcom, its stock price really came down. Microsoft went down. So this space, a couple of the big players didn't do all that great. Palantir was up. This space here did really well. Software applications like Salesforce announced, and not immediately after their earnings, but the following day, the stock rallied more than 5%, and then it came back the next day and boom, went up another 5%. So that's a good sign for software companies, in my opinion. There was also good news from MongoDB, MDB. They announced on Monday, and on Tuesday, their stock went up like 22%. So there's good stuff happening in software. I've got my eyes on this space. I think I can make some money long term here because this space has been beat up. It's been pushed down. Prices have been really pushed down. Looks like Herdo is on. It is great to see you, Herdo. I hope you're having a nice weekend. I hope you're making money here in December. Thanks for joining me. Let me know if there's a stock out there you want me to take a look at. Now, looking at other stocks that have been moving, of course, our friends over at Netflix, they had some big news that they're going to acquire Warner Brothers. And that was not greeted with a rally in the stock. It actually caused a sell-off in Netflix stock. Now, it may be a long-term win for Netflix to acquire Warner Brothers because they have a lot of content, a lot of movies. They have HBO. So I think the viewer, and I've been a Netflix customer for as long as I can remember, I think we're going to be able to see some better movies and stuff on Netflix. But so far, not that great. Netflix's stock has really been coming down over the last couple of months. It is a stock that I've been saying has been priced too high. I've been saying that for about 9 months, 12 months. So it's not something that I started to say here when they acquired Warner Brothers. We'll see how the market treats it. A stock that's been just flying up is Apple Oven. I own the stock, and geez, it's been a good one. Meta is bouncing off its lows. It sold off after it announced earnings and was spending too much on CapEx. But it started to rally, and then Meta announced, hey, we're going to cut back on the AI or on the spend in the metaverse, the capital that we were spending. And the market really liked that. The stock really moved up. So good stuff coming out of Meta. Before I move on, let me say hello to Mark. Let's have a look at Copart. Let's do it. What's going on over at Copart? Let me note that down. I've got a couple of things to cover, and then we're going to get to Copart. Thanks for joining me, Mark. Hope you're doing well. Mohammed, very good to see you. Thanks for joining. Good to see you. Jeff. Cool. You're welcome, Jeff. Yeah, Penn State's not a good year. It kind of a collapse year, and we'll leave it at that. All right, so financials. We've got some stocks that were moving higher. Citigroup moved up higher for the week. Wells Fargo, good stuff there. Asset managers moved up. Capital markets players. Robinhood is just, it's going higher. I know it's incredible to think, why are these guys keep going higher? If I show you the fundamentals, especially their overall top line growth on revenue, and you look at their profitability, just staggering how that combination is so valuable. That's why I bought the stock a couple of years ago. I'm really glad I bought it. It's my number one percentage gainer last 18 months, 24 months. And just they keep getting better. They keep getting more valuable. So I'm staying in. Let's see, what else is interesting that I wanted to point out? It was interesting that the aerospace and defense space is beginning to sell off. And we're going to cover an aerospace and defense stock by the name of AXON, Axon. It was a request from one of the members, and he got me the message, and I'm going to research that one. So I'm going to get to that one in a little bit. Healthcare didn't have a good week. For the most part, it was kind of beaten down. I released a biotech stock, the best and worst biotech stocks to invest in. I released it today to advanced members or higher, which means advanced, super, platinum members can view it. I spent 2 days, quite a bit of analysis on that video, just to get my head around biotech. There's been some really good winners there. And biotech in a lot of ways is like semiconductor. When a company gets a patent on a drug that really works, a therapy, a treatment that really works, it just sells really, really well, and they make a lot of money. So if you're an advanced member, super investor member, or platinum member, take a look at that video, and I hope you find it interesting. So did that, actually finished it this morning and released it out to everyone that is a member. Energy had a decent week. Oil prices had been moving up a little bit. Utilities had a horrible week. Real estate didn't have a good week. So what's going to happen next? Well, for the month of December, we tend to have a Santa Claus rally. And the Santa Claus rally tends to be because Investors want to position for 2026. Early in the month, you may have, or maybe in the month of November, you had people selling to harvest tax losses, and that kind of stuff gets done. And then investors position themselves for 2026. That's certainly where my head is. And then we could see a Santa Claus rally toward the end of the year. It'll be fun to watch it. We will cover it on the streams. Anderson, great to see you. Happy Sunday to you. Thanks for joining. So this coming week with the Fed meeting, I think that'll be, that should go as planned. Now, this week has some really good earnings. These earnings are going to move the market. Tomorrow, December 8th, Toll Brothers, home builder. That one's probably just going to kind of get everybody warmed up. Tuesday, AutoZone. That's a pretty good size cap. You got Ferguson, which they do like plumbing materials and stuff for the trades. Casey's General Store. This came up. A member brought this up on a member call. I remember looking at it. They do convenience stores that are located with their gas stations. Aero Environment. This is an aerospace and defense company. And we'll see how they announce, see if they're growing. So those are happening on Tuesday. Wednesday gets hotter. Adobe, big time. This one, I'm expecting Adobe's going to keep working. The stock's going to keep rising because I think software is kind of beat up. Synopsys is a software company. It's for the semiconductor space. They're going to announce on Tuesday. Chewy. And then the others I'm not all that familiar with. It keeps going. Thursday gets a little bigger. Broadcom, a 1.7, $1.8 trillion market cap company, announces this earnings will be important. We'll see if they're growing really fast, if they're sustaining their growth, and if they're going to hold their stock price. This is an expensive stock. If you look at the PE ratio for Broadcom, it's very high. And if they keep growing, no problem. But if they have any kind of pullback, slow down, they're going to have their stocks really kind of crash because it's so expensive. That's the risk of buying a stock with a really high PE. Costco, that stock's been struggling. Stock struggled for well over a year. And are things going to change? I don't think so. I think Costco is, we know what it is. It's a big box member program retailer. I think it's a really good brand, but the stock price is really high, really expensive, high PE. Yet they're not really growing all that fast. For a retailer, they're doing okay, but if you compare it to any other industry, the fundamentals look bad. So we'll see what they announce and how the market reacts to their earnings. Sienna, I'm not sure what they do. Lululemon apparel. We will see how I think this one here, Lululemon has attracted investors like Michael Burry. They do have very good margins. And I could see this stock announcing good earnings and then rallying higher. I'm not an investor. I don't plan to be an investor. I'm not a big apparel guy, like stock guy. So I'm probably going to sit out, investing in Lululemon altogether. But I could totally see the stock going higher if they announce really good earnings because they have very good margins. Their growth has been pretty good. Their stock had gotten so high that once they had some problems, you saw a big sell-off, big pullback that has lasted a year and a half, 2 years. If you're a football fan over in Europe, you could see Manchester United. You could see how much money they make and all that good stuff. Isn't that interesting that a professional football club is publicly traded? You also have here in the U.S., you have the Atlanta Braves. That's a publicly traded stock. So if you want to own a little piece of the Braves, you could buy a few shares. Warren Buffett owns a little part of the Braves. He owns there's nothing that Warren Buffett doesn't spend a couple million on. So he owns, I don't know, like $20 million or $40 million in the Atlanta Braves. But it's interesting that some professional teams, sports teams, are publicly traded. So that's what's going on in Europe. And Friday should be a quiet day. They tend to be quiet on Fridays. So that's what's happening, man. We're going to have plenty to do this week. And I think the Broadcom earnings is big. Adobe is big. Costco is big. We should have plenty to work on. Looks like Kurt is on. And I think, Kurt, you were the one that brought up Casey's a while back. We looked at it. So RIGL is beginning to move. Let's take a look. And I agree that several healthcare stocks are beginning to move. I really like the momentum. And with healthcare, it's been beat up for so long that I think it could have a long rally. It could rally all 2026, go into 2027. I like that. And I would say the same thing about software. That picking the right horses as we enter 2026, we could ride those really good stocks and have outperformance in 2026. I think healthcare does have good ideas there. We'll look at RIGL and see what is cooking there. I haven't looked at it in a little while, so I look forward to seeing it. Thanks for joining, Kurt. Good to see you. All right, so we covered the earnings calendar. I can check that off my list. And a couple of things that I'm going to cover. Looks like I've got 4 stocks that have been requested. 2 have been requested on the live stream. 2 were requested prior. So we got 4 stocks to cover on the stream, and keep them coming if you're out there and you want me to cover a stock. If you're a member, it just comes with your membership. If you're not, even you buy a $5 super chat, then I'll review the stock that you're requesting. And I also, in addition to reviewing stocks, I'm going to go through the valuation sheet that I keep, and I'm going to update it and kind of give you guys a tour of that valuation sheet. I'm going to do that after we get through the stocks we're going to cover. And I'll give you a tour of it, how you can use it. If you're a member, you get access to it if you're an advanced member. And you can refer to it 24/7 and look up the valuations that I have in there. So I'll be updating it and giving you a tour of it here on the stream. And I think that's it before we crack open a company and start looking at what we've got. So let me close a few tabs here and we'll get started. So I think somebody wanted to look at Copart. Copart provides online auctions and vehicle remarketing services in the United States, the United Kingdom, Germany, Brazil, Canada. Yep. So I remember this business. So this is their website. So as a consumer, I think you can go on here and buy a car. They also do auctions themselves. You can buy a membership. You can start a small business, right? I know in California, you need to have a special permit to be a used car business. That way you can take the advantages of not having to fully register a vehicle when you put it into your inventory, and you reduce the administrative cost, and then you can resell it. But these guys are a way of you cutting into that business if you'd like, or if you're a consumer, you can go on and buy a car. So understand what they do. What's the stock been doing? The stock has been struggling. Not pretty. Down 38.5%. Why is that? We'll take a look at their revenue and profit and stuff. to see, is there a problem with the business? Why is it down so much? Now, high level, right? I think in 2026, the automotive industry is not going to have a good year. And why do I say that? Is when we had COVID, we had some supply chain disruption, and um, it became an environment where the price of cars really went up because there was scarcity. If you recall, like cars were just getting marked up left and right, and the consumer got really stretched when it came to cars. Now we're back into what I'm going to call more of a normal situation, and the new cars are really good and they're priced quite well. I think plenty of good options for consumers. So the used car market is kind of getting squeezed because the used car market was flourishing 3 years ago, but now not so much. It's pretty much, who's buying cars? Not as many people as before. So I think they're going to struggle to have good revenue. Looks like Bo is on. That's our guy. Cool. So you're a Manchester guy? Awesome. I'm looking forward to the World Cup. I think that's next year. Yeah, I am doing great. Thanks for stopping by, saying hello. Have you heard of QXO? Yeah, I don't think I've ever looked at QXO. If you'd like me to look at it, you want to buy a super chat, I could definitely look at it. Thanks for tuning in. Sweet. All right, so let's get further into Copart. So we have a $37.48 billion market cap company. We have revenues of 4.66. So that is fine. Forward P 23.26. That seems okay for now. Analysts are saying, hey, this stock's discounted by 23%. All right. Well, we'll take a look, see if we agree or disagree with them. Let's take a look at where the stock is supposed to go with its revenues. How many analysts cover it? 5 analysts. And this stock, they're supposed to grow. We are in the year that's going to end July 31st. They call it their fiscal year 2026, but it'll end July 31st, 2026. In that year, the company will have grown 4.5%. Earnings per share, really low. Geez, you are getting this business at a fraction of what you would buy. Like I think I earlier said, hey, Broadcom has a PE of almost 100. And this company, EPS, earnings per share, 1.7. Ooh. And I think I read the wrong line. 22.76 looks okay. Earnings per share is going to grow. And I like this year here, 29. What's going to happen in 2029? It's a little far away, but it looks pretty darn good. So I like to see that they're going to grow their revenues. Maybe this is a little opportunity. Those who invested in Carvana a couple years ago, man, they made a ton of money. And there was one investor, I think it was Rob Vinal. He's a famous investor I track. He put a lot of money in Carvana, and he made a lot of money for his investors. Good job, Rob Vinal. Okay, so I'm liking the growth. Let's see what kind of cash flow we're dealing with here. So this company has cash flow of 1.41 billion. They're growing well. Okay. And they have less debt than cash. Nicely done. They have like over $5 billion of cash and almost no debt. Very nicely done. And I want to look at their margins to see how attractive is this business. Do these guys make a lot of money, or do they make very little money on each transaction? It looks pretty decent for being in the automotive business. If you have gross margins of 47, that's very good. Profit margins of 33, it's very good. This looks really good. These guys are making money and they're growing. Why does the market not like these guys? I think this stock is either fairly priced or discounted. Let me see if I've got a valuation on these guys. I don't know if I do. Look at that. We've got one. Just a little dated. Let's update it. See what this thing's worth. So I'm seeing some fundamentals that are looking pretty attractive. Now, the car business and owning dealerships, or in this case here, it'd be a company that's doing auctions of used cars. Not my favorite industry. All right. So we're going to look at, I'm going to look at another screen that you guys can't see just so I can get the details and then enter them into this model that I've created that is going to give me my valuation for this stock. So just looking at the balance sheet again, this company has $5,240,000,000 of cash and a little bit of debt. Not too much. All right. Okay, so now I want to go look for cash flow. And the cash flow rose from the last time I looked at it, because last time they had, let's call it 1.2 billion of cash, but now their cash flow has increased to 1,410,000. That is a very good move in the right direction. I'm going to say it's growing at 10%. I think that's reasonable. Okay, that looks good. Now let's take a look at earnings per share. And I'm going to use the earnings per share for the year that follows 2026, fiscal year 2026. That's $1.85. So these guys are growing nicely. I'm going to give them a P of 18. And then from there, I'm going to grow by 5%. So the valuation isn't all that great. Why is that? Well, the cash flow is good, but they're not growing like tremendously, right? We're growing single digit. For the next 3 years, they're going to grow mid single digits. So it's not like incredible growth. Earnings per share is also not overly incredible. And so I get a valuation where I get a decent discount of 13%. Analysts believe this company, this stock is discounted by 23%. And this really doesn't get me into the stock. I'm not excited about a 13% discount on a business like this. If I saw 50%, man, I would really entertain it. And at times you'll see that those kinds of discounts. We're seeing that the market doesn't like the stock. It is like said, no, we don't want to be in that business. And it may be that the big macro picture for automotive doesn't look good. It doesn't look good for maybe a couple of years. And if it's going to be rough, maybe investors are going to stay away from the space, and it's going to be hard to see a stock rally higher within this industry. So for me, Copart is a pass. I think it's not discounted a whole lot. I think they could probably see some short-term rallies here or there, but I don't think it's going to be a great winner in 26 and 27. I think it's just going to exist, catch a few rallies here or there, but the last year has been pretty rough for investors. So that is Copart. The first stock is done, completed, and we move on to the second stock. The second stock we're going to look at, I think, was it Kurt that asked for RIGL? Let me get that staged here. RIGL is Rigel Pharmaceutical. I'm going to park this for a second and just catch up on my chat here because it's beginning to blow up. You guys want to talk about stocks. You guys may be like me. You got the football game going on in the background, but really your head's in stocks because I think it's funner to make money on stocks than to watch football. Looks like grape soda. I'm thinking of putting most of my money in AMD and Meta. I like Meta a lot. I'm not a big fan of AMD. I valued it before. Can we look at Super Micro? Let's do it. Good to see you, Benton. Super Micro Computer. And that was part of a computer hardware best and worst stock that I created, I'm going to say 2 weeks ago. And I put Super Micro in there. And maybe we can, I don't think we have to refer to that video because it was only like 2 weeks ago. But I'll give you my comments there. I've been following Super Micro for some time. All right, so grape soda 7. By the way, I found you this spring, made a lot of money. Google, nicely done, sir. Nicely done. I think Google is going to go higher. But I'm glad you found my analysis and my research interesting. Betting, doubling down. Wants to talk a little Super Micro, a little SAP software. Glad to do that. Let's talk SAP, the big German software company. Has a very successful history. Let's take a look here. Man, you guys are blowing up the chat. Thanks for doing so. It makes my viewing experience interesting. Do you think taking a look at Broadcom, Avgo? Do you mind taking a look? I could just buy a super chat. We could take a look at Broadcom, analyze it. I've got a lot of analysis on that one. Going golfing, Victor? No, not going golfing. I am staying in and just I've been helping my wife around the house. She is decorating. She decorates for Christmas like this is her Super Bowl. She's doing a great job. I'm her laborer. Adobe's coming up this week, and that's Seba Tarth. I think that's your first time posting. Good to see you. Thanks for joining. And again, if you guys aren't members and you want me to look at a stock, just buy a $5 super chat. I'll be glad to look at it. Anderson, Fiserv. And you got a super chat there. Yeah, we can look at it. And I think Fiserv has been an example of a stock that's really been beat up. And I'll put it on the list. Fiserv is also a software play. I think they do software that's very focused on one industry. So, and see, that's a big question right there. Super Micro, is it worth holding? Well, I'll give you my comments. I haven't held back on Super Micro. I know them from having invested in hardware, semiconductor, and I really have paid attention to Super Micro for the last, call it 2.5, 3 years. So, all right. Happy wife, happy life. There, that's very wise. Yeah. I'm looking forward. We had a nice Thanksgiving. We're gonna move on to the other holidays, Christmas, New Year's, and it should be a good one this year. All right, back to the action. We're moving into Rigel. Rigel is a pharmaceutical company, and they're listed as a biotech company. They're a small company, 888 million in market cap, not even $1 billion. So it's small. Revenue 282. Forward P is really low at 12.5. Analysts think it's a little too expensive now. And they think that because look at that. Rigel is, boy, this volatility. Crazy. Man, I hope you own this one, Kurt. Because over the 1 month, it's up 72%. Talk about a lively stock. This one is alive for sure. So that's a very good gain. It's really rocking and rolling. It's really going higher. Over the 5-year, you see that it had a big drawdown back in 2021, 22, kind of bumped along here, but really starting in 2024, this thing started to go higher and you had to deal with some drastic volatility. But boy, man, if you've been around for the last 5 months on this stock, you are dancing. You are so happy. You've taken your capital from a little less than $20 a share up to $50 a share. That is like doubling your money and then some. Who wouldn't want that over a 5-month period? So that looks terrific. Now, this stock here has been a growing stock. Look what they did here in 2024, grew really well. And let's take a look at their forecast. Before I move off, let me look at trailing 12 months and just take a peek at how profitable they are. So they're growing really fast. That's the first check mark of, do I think this business is really attractive? Attractive in, I'm going to make a lot of money. Attractive means fundamentals are great. They make a lot of money. They produce a lot of cash flow. And these guys are producing cash flow. They're little. They're less than $1 billion in market cap, and they're already producing $68 million of free cash flow over the trailing 12 months. So 68 million in free cash flow. When we look at their gross margins, 83% is a very good gross margin number. Excellent. 40% profit margins. Excellent. These numbers are looking really good, guys. No wonder this stock's like just going crazy. When did they announce their earnings? November 4th. So if we look at November 4th, we are at December 7th. So really, it was back here. And since they announced their earnings, they're up 72%. So they probably announced something really good, right? 5 analysts cover them, and they're like, geez, they've gotten a little expensive because they've gone up 72% in the last month. Yeah, well, I could understand that type of sentiment on the stock. So we are working in this year, December 31st, 2025. They will be finishing this year. They are growing quite well. What is a little unusual is they're going to slow down to basically just grow a tiny bit next year and then come back and start growing again. I wonder why. Why is it? So I'm going to do a little more investigating to try to get an answer to that. And their profits are kind of going down and will not be as good as what we're going to see here in 2025. That is interesting. And it's not matching the stock price appreciation. Why is the stock appreciating so much if it's expected that they're going to slow down next year? Okay, well, let's keep looking. Now, I'd like to look at a couple of things. So first, I'm going to ask Gemini for some help here, because Gemini AIs, and you can probably use ChatGPT, it's been doing a nice job of looking up data. It does a really good job of looking up data. And the question I'm going to ask is, when are the main products this company produces going to lose their patent protection? And it looks like they're going to have patent protection until 2032. That's good news. Their drug was approved 2022. And what we may be seeing is that slowdown is they started distributing in the US, and then they're going to fill the demand for the US, and then that uptick in growth that's going to come down the road might be, hey, and then we're going to start selling in Europe and other parts of the world, and that's when they start growing later. So that might be the case. So that's good news there. I would also look at the investor page for Rigel. When you're going to invest your hard-earned money, right? You want to answer as many key questions as possible. We have a clear view of the company, and we don't want any surprises. We don't want surprises that cost us money. So let's try to find our last earnings and see if they give us any sense of guidance. See if they're giving us information that's useful to understand what their future looks like. So I'm going to make this a little bigger here so you guys could read it. So the third quarter, we know their revenue's growing great. Perfect. Okay. So outlook for 2025, we knew that already, that they're going to grow. Okay. Okay. Clinical development. So they're working on some additional drugs. Okay. So they're just talking outlook for 2025. We already kind of believe they're going to do well for 2025. I'm more worried about 2026. So let me do a quick search here and look for 2026. They're not commenting on 2026. So the analysts somehow are believing that the company isn't going to grow. If you compare the numbers, the revenue numbers from 25 to 26, there won't be any growth. So, all right. So let's get into a valuation here and see what I think Rigel is worth. I know we've talked about Rigel, and it's a tiny company. It's one, I know that I think a few investors have brought up this stock on live streams or member calls. I have to recollect at least for 9 months. So I have to think a couple people that tune in that are part of this community are invested, which I'm happy for them. Glad you're making money on this stock. I'm not making any money. I didn't invest in it. It is a little bit risky when you invest in these small caps. Some investors love investing in small caps. I can't blame them, especially when companies are going to perform like this. So here's where we're at. So we got free cash flow that for the most recent quarter, the trailing 12 months was $68,140,000. Now, I know that they're not going to grow next year. So we got to scale back the growth. So the growth, I'm going to say, is going to grow by 5% over the next 2 years. And they're going to come back and start growing. And they have that patent protection until 2032. So let's call it 6 years from now. All right. So I adjusted the growth rates. Years 1 through 2, just 5% growth. Then 3 and 4, growing at 15. Then long-term growth at 5. The cash on the balance sheet, let me go get that information. They have $137 million of cash. And then they have $60,880,000 of debt. So good balance sheet. I use a higher discount rate on these smaller caps because it's a higher risk. So I want to be compensated for the additional risk I'm taking on. Even when I use that higher discount rate, we're still seeing a very good discount of 54%. Even after the stocks rallied 72% for the last month. So this stock's showing good value. Now let's take a look at the earnings per share that we're expecting next year and what that number looks like. So next year, they're going to do $4.40 per share. I'm not going to give them a 36 because they're going to slow down. In fact, I'm going to take that to 18. Then from there, they're going to grow nicely. So we'll go to 15. So really, Rigel is a discounted stock. And this one's a tough one. When do you buy into a stock that's flourishing like this? Man, let me tell you, investing is science and art. And deciding when to buy, I try to follow a process. That way I get myself into good situations more often than not. But this type of chart really is hard to jump into. And I don't know, Kurt, if you're in the stock, I hope you are. And I don't know if you're thinking of buying more shares, but man, this one's really worked. And I think it could go higher. I think they could be acquired too, by the way. This is a tiny cap. A bigger pharma company come in and offer $2-3 billion. And I think the company would be happy. The shareholders would be happy. So that is Rigel. It's discounted. When to buy into the stock, right? If you use the rear view mirror, it tends to rally hard because the good news comes in and then it gives up some of the gains. Maybe profit taking happens. But if some profit taking happened again, that might be a good time to enter. Or if you feel like, hey, this thing's just going to keep rallying higher, well, that might be a different thesis to think about the stock. The one thing I'd be worried about is next year, they're not going to grow a whole lot. So that's a little spooky. But once you get through that year, if they start growing again, this thing's going to be worth a lot more. So congratulations to all those in Rigel Pharmaceuticals. I'm so glad that months ago, 9 months ago, 12 months ago, when you guys started bringing up this stock and we valued it, you were really digging where there was pay dirt. So good job for whomever brought it up. I think it was, God, who was it? Was it Herdo or was it, I forgot who brought up Rigel, but I'm glad you did. It's an interesting stock to have followed. All right. So we got Fiserv noted, Shadow Guy. Is it too late to buy into Warner Brothers Discovery? I think so. I think it's priced to basically you're getting 95% of the potential acquisition price. It's kind of that ship sailed. And it's actually risky because if you were to buy and then let's say the regulators don't allow for Netflix to acquire Warner Brothers Discovery and you bought in at the high price, oof, that may not be fun because if it sells off, it'll be painful. So, yep, I can cover Chevron. If you want to buy a super chat, or if you become a member, you can request for me to look at Chevron. And it's a good company. I've been an investor for a while. So Carvana, CRH, Comfort Systems to join the S&P 500. Cool. Good stuff. Man, Carvana to come back has been incredible. I thought they were done. So Kurt, do you think the big uptick on Adobe? Yeah, I think it's a very good signal that now investors are paying attention to the software space, the software stock space. And I think it's a very good opportunity to look for companies in software. I'm certainly going to bet big on software, including Adobe. Shadow Guy. By the way, just had a class on agentic generative AI. And use Claude. And Claude is produced by Anthropic, right? Very cool. Yeah, cool. Interesting. I caught the Rigel tailwind. Cool. Good. Glad you made some money. Falls Grave. You want to look at Poet? Let's take a look. All right, we got Poet on the list. Kevin, you don't mess with pharma. Hey man, you pick your lane, you go find out where you can make money and become good at it in that industry. All right, so we went over Rigel. That was the second stock. I'm going to cover the next stock that was requested in advance, and that's Axon. Okay, so I thought what would be interesting is I did a video on Axon about 2 months ago, and I'm being asked to look at Axon again. So let's take a look at what I said 2 months ago, and then I'll reanalyze it. I thought that might be interesting for this stream. Axon provides products and services for law enforcement, the military, and security forces around the world. It is a $46 billion market cap company, and it has a really high PE of 187 for the current year, almost 85 for next year. That's a really high PE. Over the 5-year, this stock has really flourished, but you can really see that high stock price show up in that PE ratio. Analysts are still really positive on the stock, believing that it is discounted by 35%. Looking at the 15 analyst reports, one analyst believes it can go up to $1,000 per share. And the worst case scenario is at 610. So everybody thinks this stock could go higher. The growth rate is really impressive at 33% growth this year, getting down to 24% next year, and then following with 22%. The EPS is not going to grow as fast. So notice that they have a lot of cost in making their product, delivering their product. So it's the actual profits are not going to grow along with that revenue. Therefore, the PE ratio is going to stay really high for a while. And that is a really rich PE, in my opinion. Based on my research and valuation, I believe Axon is priced 67% too high. So I concluded that the stock was 67% too high. And this video was created on November 6th, I believe. So that's kind of like where I was 2 months. Is that right? 2 months ago or a month ago? And 1 second, I got to double check my dates here. Last 2 years, we've had some conflicts coming out of Russia. November 6th, that's right. All right, so November 6th, I was saying the stock's pretty expensive. And now let's get back to this company. What's it done for the last month? It's gone down 22%. So not a good situation to have been a late buyer of this stock. You see that this stock really does have exciting revenue growth. Good. That's always good. It also, if you look at the rear view mirror, it's had an exciting rise, right? Man, boy, you reminisce and go, wow, if I would have been in the stock in 2022, I would have made a lot of money, right? But we got to really be disciplined and go, okay, well, there's nothing wrong with a company having had a very good last 5 years or last couple years, but we're not investing based on the rearview mirror. We're investing looking forward. And that's where my analysis started on this company. So looking at this stock, it's a $43.48 billion market cap. Revenue 2.56. That's the first signal that you're paying up for this stock. What this means is you're paying about 15 times sales. Once you get to 10, anything above 10 is, you can say, is expensive. If they have high growth, it could be worth it. If it's below 10, there's different levels of, hey, that's a discounted stock. That's a value stock. So we're in the, hey, this could be expensive zone. Forward P of 79, expensive. Analysts think 45% discount. Okay. So let's take a look. So what does Axon do, right? Exxon Enterprises provides public safety technology solutions in the US and internationally. The company operates two segments, software and sensors and Taser. The software and sensors segment develops, manufactures, and sells integrated hardware, cloud-based solutions, software solutions that enable law enforcement to capture, store, manage, and share and analyze video and other digital evidence. So they're doing a couple of things. They're doing some hardware for law enforcement and some technology. Okay, so that's what they do. They have good growth if you look at the full year. Looking at the quarterly, the growth persists, the growth continues. And looking at the margins. So gross margins of 60%, it's pretty decent. And then profit margins of 10%, which 10%'s a little light. The free cash flow margin is also fairly light. You see these light numbers here. It was a little better in 24, but now it's really gotten a little light. We've got 14 analysts covering this stock. They think it's a good stock. They think it's really discounted by 45% because the stock's been dropping. Now, their forecast is saying they're going to keep growing. But this PE ratio stays really high. So that's where I think the market's beginning to realize, hey, this stock's expensive. It's going to take a while to get to a rational PE. And let's see what kind of cash flow these guys drive, right? So if we look at their cash flow for the trailing 12 months, they did $145 million of free cash flow. Okay. Now let's take a look at their valuation, and I'll go ahead and update it. So last time I updated it November 5th. So we're a little over a month later. I'll go ahead and change that to 7.5. And let's start looking at some fundamentals that I like to use when I value a company. First is discounted free cash flows. And when you value a company using this, you're following the method that most successful, famous investors use. At the end of the day, an investment is worth the free cash flows it's going to produce. And back when I analyzed it, I actually used a higher free cash flow number versus the one that I have. So what's going on here? Trailing 12 months. Yeah, the cash flow is kind of terrible. Man. Yep. The free cash flow is really, really low, and it's been low. It's not like they had really good cash flow before, and then all of a sudden they had a bad year. Nope. It's been bad, and it's still bad. I think what I did last time was I looked at their cash flow and thought they're not going to have to keep putting CapEx back into the business all that much. So this is, their operating cash flow is really low. So this stock is just really expensive. It's really expensive if we compare the value of their cash flows in the future versus its current stock price. And, top line revenue growth is very good, but what's ideally an attractive business is top line growth, great margins, great cash flow. You have those three factors, you're a very desirable business. If you have the top line growth without profit and cash flow, it's not enough. It's not enough. And the market's beginning to sell off this stock. Looks like, and I think I'm looking at the wrong. Yeah, sorry guys. I was looking at the wrong symbol. Okay, let's start over again. Sorry. So yeah, here we go. 145. And then free cash flow, but it's still not good cash flow. So that number is fine. This number is fine. Let's see if the earnings per share has changed. So earnings per share, it's come down a little bit. So situation's getting worse. Now it's a good growing business, but they don't have good profitability and cash. So I went 25 on the PE. So I continue to think this stock's just really expensive. And I know aerospace and defense has really caught a very nice tailwind over the last couple of years. But what happens is, these stocks get really expensive, and then all of a sudden they have to, basically substantiate their valuations, and that doesn't happen, and these stocks start to sell off. So Axon is a sell. This is just too high of a stock price for what this business is worth. The market's beginning to really just sell this thing off. And I think it's who's going to come and invest in it next, right? I don't know that a lot of investors are going to be up for it. So Axon's a total sell for me. And the comments I made a month ago, I think are, similar feeling that I have now, which is I'd stay out of the way of this one. So that is Axon, and that was requested in advance of the live stream. I'm glad I covered it. All right, so on the list to go, we're going to cover Shopify, Supermicro, SAP, Fiserv, Poet. And the next one I'm going to go to is Supermicro Computer. I'm going to take a look at that company. That company is a company of the, for the times. It's an AI related company because they do high performance computing. We're going to take a look at the valuation of that. I think it's been a little while, and I may not have a valuation, but we'll see. So, Mark, with data centers needing more energy, is energy sector something? So, it's a theme that I'm working with, but I don't know that there's a lot of money to be made. I started buying into a pure play natural gas producer because natural gas is the most popular energy source that they'll use on site at a data center to turn those turbines. But I don't know if there's a ton of money there to be made. So I'm just playing it, I'm putting a position down on EQT and seeing if that'll work. So I'm with you on logic, but I don't see a big gain there. Bo, Chime is getting more traction. Good to hear. Take a look at Chime. And Chime, I think, I know they do financial services. We'll take a look at what they do in a little bit. All right, Supermicro. Let's talk about Supermicro. And these guys, when you look at their stock chart, you're like, whoa. Once we knew that we're going to be building out large language models, these guys got super hot and the stock got really expensive. And the thing that you got to be careful with, remember, a very desirable business means they're growing their top line real fast. Great. They're really profitable. They generate a lot of cash and they have a good balance sheet. And the piece that's missing for Supermicro is, they were growing really fast. Check. Do they have really good free profitability? No. Their gross margin, the gross margin is 10%. That's a very low ceiling. Their profit margin, 3.77. Let's take a peek at our friends over at Nvidia. They're the ones that are making all the money in the space. So Nvidia has the revenue growth, 65% on the trailing 12 months. Beautiful. And look at the gross margins, 70%. Check. Profit margin, 53%. I'm not going to use check marks. I'm going to use gold stars. And then free cash flow, 41%. So very desirable. This is incredibly valuable, which is why Nvidia is the most valuable stock on the exchange. Back to our friends at Supermicro. This is nowhere near what Nvidia is doing. Now, hardware is like this, computer hardware. So it's not about, oh man, they're growing really fast. Okay, that's great, but are they going to make a lot of money? And I would say no, they're going to struggle. And it's a very competitive area because Supermicro doesn't have anything proprietary, meaning they can't defend their marketplace, their market share with patents like Nvidia can. Nvidia sells a GPU. Other competitors can't like copy their GPU and sell it. No, the patent protects them. And they're like, no, you can't do that. Supermicro is basically an assembler of computers. They buy semiconductors from Nvidia, from everybody else, AMD. They buy, hard drives from so-and-so, and then they assemble these computers and then they sell them and they have very low margins. So that's one piece that, really is important to keep your eye on is what type of business am I valuing here? Is it a really, really desirable one or is it an undesirable one? And I would say that Supermicro is an undesirable one, which is why the market sold off the stock. Now we have 16 analysts covering it. Some analysts think it go much higher. Some analysts think it's priced right on the button. They're going to grow, but not as incredibly as they were growing before. And it looks like a couple years down the road, they have a fiscal year that ends in June. And I guess 3 years from now, it's going to hit kind of a wall of growth. And it may happen sooner. Earnings per share is going to grow nicely. And their PE ratio is going to come down. Right now, it's already down to 16.5. It's going to come down to single digit at one point. So hardware is not a space for me. I learned this in the 90s when I invested in Sun Microsystems, and it didn't go well. It's just hardware is really tough business. If you look at Dell, you've had periods of time when, that stock really rose, but it's really been hammered too. Hewlett-Packard Enterprise was selling off harshly last week. And Supermicro is, I think, going to continue to see pressure on their stock. This one here is just, I wouldn't touch it based on, I first want to buy into a business, or I should say, I want to believe in the business. And Supermicro is just like, man, I believe you guys are going to have a lot of competition. You're going to struggle to make money. That's what I believe. And they did have accounting problems, where their auditor basically resigned. And I don't think they were doing anything wrong. It's just a bad look when your auditor's like, yeah, we don't want to be your auditor anymore. And they had to go find one. They were late to issue out audited financials. And again, I would say, I don't think they did anything wrong, but it's a bad look when your auditor wants out. Like, hey, this is risky. We want out. We don't want to be on the hook should things go wrong here. So that's Supermicro there. I don't think I have a valuation because I was valuing the company for a while, like 2 years, and the numbers just became too stretched. I'm like, when you look at a Supermicro and this type of business, I would go like maybe 10 times free cash flow. So let's look at free cash flow. And they have cash flow of 218 million. So 10 times that, it ends up being call it 2.2 billion of market cap value. I add cash, take away debt. So I'm taking away close to $1 million. I'm down to $1 billion of value, like 1.2, 1.3. And the stock's way up at 20. So I'm nowhere near like the valuation that the market's giving it. And this is the stock that the market took it to some crazy number, $100 a share. So it was 3 times more valuable than it is now. It was at 60 billion. And really, if I value the cash flows of the business, it's really only worth $1 billion or $2 billion. That's it. And back here, that's where it was priced. It was priced like a hardware company. And then AI happened. Everybody went nuts and started buying hardware companies like they were really worth a lot, which they're not. And whoever bought here just got hammered, lost 60, 70% of their investment. So Super Micro, I am not touching it. I would, you know, how you see those videos on steel mills when they're working and they have all that melted steel, and you see the workers wear these protective uniforms with a shield, and the uniforms themselves are like aluminum covered so they don't have the heat kind of hurt them. That's the kind of uniform I'd need to analyze Supermicro. I'm afraid I might get some radiation poisoning out of it, but that's a joke, of course. But Supermicro, I wouldn't touch it. All right, let's touch on SAP. SAP I can analyze quite easily. SAP is a software company. They are a big company software program that does financials, supply chain, manufacturing, human resources, everything that a business kind of to run. That's what SAP does. They've been around for a long time. They carry a high PE of 32.3. Analysts think it's discounted. And when we look at the stock, hasn't been a performer. The 1 year doesn't look good. The 5 year looks a lot better. Man, from 22 to 24, good stock, really good stock. But the last year, what happened? How come it's not performing anymore? Doesn't pay much of a dividend, kind of a small dividend. Is it growing? Last year, they grew by 9.5. If you look at the quarterly, they had a couple good quarters of growth, and their most recent quarter showed a little bit slower growth. That is a concern. Like, hey, why are you guys see? Because a software business like this, they grow in a couple ways. One of them, obviously, is the old-fashioned way. You get more customers, and you sell them your product, and you grew. But these guys also get to increase their prices quite regularly, and it looks like 7% growth is mostly price increases. There's not a lot of organic growth in there. That's concerning because if you're not growing, your competition is. You have new businesses that are growing and need software that SAP makes. And if SAP doesn't win the deal, somebody else won it. So that's one area of concern. So that's what's going on with their growth. While we're here, let's take a look at their free cash flow rate. Is it good cash flow? Do they have good margins? So gross margins of 74%, those are good margins, good profit margins. Free cash flow yield's pretty damn good, very good. So that does have a lot of value to it. And they are a very steady company. The thing about SAP software is they have big companies running their software. And those companies, if they decided to move off SAP, that's like a couple year minimum decision. Like, okay, we decided to move off, like 3, 4, 5 years down the road, you're finally off the software. It is very difficult to move off. So that is a good thing for SAP. They hold their customers for a long time. We've had 4 analysts. They're all positive on the stock. Looking at their forecast, looking forward, they're going to start growing. That doesn't look bad at all. 11%, 12, 18. That looks really good. Profits are going to expand. That looks really good. This is looking pretty darn good, by the way. So I think I have an SAP valuation. Let's update it because I think it's probably a little dated. And I don't have SAP. I don't have SAP in here. We got to change that. We got to have SAP in here. So let's put these guys next to Salesforce. See if Salesforce might rub off on them. They go up 11% on 2 consecutive days. All right, so we're going to create a valuation on SAP. See what that stock's worth based on cash flows, profits. See if it's a stock worth investing in. Okay, so back about, 25 years ago. Yeah. 26 years ago, the company I worked at, we implemented SAP. And it took us a couple of years, got to know SAP quite well. And that was my first experience with SAP. All right, that's fine. 7.5 growth is fine. Let me take a look at their free cash flow and see their trailing 12-month free cash flow. What does it look like? So free cash flow, it's been pretty consistent. That's good. Was 6,460,000. So we're going to go with that number. And they're growing quite well in the future. Now, for year one, we're going to leave it at 10%. But then this number, we're going to go to 15. Okay. Actually, that's a little too optimistic. We're going to go to 12. And here, we're going to go trailing 12 months, just to update my notes here so I know what I did. And that gives me an intrinsic value of 234.7 billion. Let's take a look at their balance sheet. What kind of cash they carry and debt? So they have $11,660,000,000. They have debt of $10,700,000,000. Look at that, right on the button. And I need to update my share count. So let me look up my share count here. Okay, the share count was incorrect. So once I compare the value of the cash flows using their fundamentals, not mine, their fundamentals, I compare it against their market cap. Why am I seeing two market caps here? The shares outstanding on stock analysis are 1,160,000,000, but the number that Google is giving me is different. Isn't that interesting? Let me cross-check that number. So I think stock analysis is correct. And sometimes Google gives me funky numbers. So I'm going to go with the stock analysis number. All right. So based on the value of the cash flows for SAP, the stock's priced 18% too high. Now let's take a look at earnings per share. Earnings per share for 2026 will be $7.23. PE ratio of 25 is fine. That's what I gave Salesforce. And the growth rate's going to be better. So we're going to go with 15 on that line. That is growing nicely. So I think they're priced 17% too high. SAP tends to be, I'm going to imagine, because I'm not in Europe, I'm in the US, but I think a lot of people in Europe like SAP as a stock. I think it's priced a little too high. I'd rather buy CRM, Salesforce. It's discounted by 37%. Let's compare the two real quick. On cash flow, CRM is almost twice as much cash flow. Okay, so that's a higher valuation, and they're growing nicely. The market cap for Salesforce is lower than the market cap for SAP. So Salesforce is making twice as much cash flow for less than the market cap of SAP. SAP is what looks like $40 billion more expensive on a market cap level, but Salesforce is driving twice as much cash flow. Cash is where it's at. So you see the value of Salesforce, and at the same time, you see that SAP is just priced really high. And when we look at earnings per share, each share, what's the stock price on Salesforce? Stock price is 260, and stock price for SAP is 247. So it's very comparable. So very comparable stock prices, but Salesforce is going to earn $12.85, while our friends at SAP are only going to earn $7.23. So it's clear, like, I'd rather buy Salesforce. They're very similar. One focuses on like the sales, marketing, customer service aspects of a business. That's here. These guys focus more on the operations and finance and stuff. But at the end of the day, they're software as a service plays. They're software companies. So most definitely CRM is my cup of tea, and I will not invest in SAP. Man, that was fun. That was a good one. That was a good one. Who asked about that? Benton. Benton asked about SAP. Was able to mix in a little Salesforce. I am really high on Salesforce right now, guys. I think Salesforce is going to make me a good gain in 2026. It's going to outperform. And I think other software stocks are going to outperform. And that's where I'm at with those. You guys that are regulars know that I've been saying that. Sometimes I feel like I'm kind of wearing out a message, but when it comes to Salesforce, and they had a good week last week, I'm glad that I was able to, speak, out there and say, hey, I think this stock's misunderstood, and I think it's going higher. And here we are. It's going higher. And at the same time, I could say, hey, I think our friends at SAP are priced way too high. I'd rather buy Salesforce, man. That's where the profit's going to be for an investor. That's where I'm going to take my capital. All right, let's keep moving. So Benton, very well said. Super microcomputer does seem dangerous. And, investing is so fun, and it's so demanding and rewarding and all that good stuff. And we just don't have to take like chances on a business that's gross margins are 10%. Profit margins are 1%. Just not a good business. Let's go find the next Rigel that's making big profits and growing just by big amounts. Let's go find the next one for that, or the next Nvidia, the next Palantir, the next, Robinhood. Let's go find that stock. It's out there. There's going to be a good one for 2026. We got to find it. We got to find the next great one. Fiserv. What's going on with Fiserv? Anderson wanted to talk a little Fiserv. So let's talk a little Fiserv. What's going on with Fiserv? I've heard troubling things. I have heard that Fiserv has been getting beat up. What's going on? Beat up is the wrong word. Fiserv's been getting run over by a truck, unfortunately. And man, 69%. What is going on? Holy smokes. What does this business do again? Fiserv provides payments and financial services technology solutions in the United States, Europe, Middle East, Latin America. The company provides merchant acquiring and digital commerce services. Okay. Let's take a peek at their website. I want to make sure I put them in the right place in my mind. So these guys are payment systems. So the Fiserv, so they do point of sale. Okay. So who we are. So they do billing, payments. So they're like PayPal. They're that type of company. Okay, so they're a $35.65 billion market cap. And by the way, like payment companies, they've been getting sold off. PayPal has not flourished. I know that I want to say, I don't know that a payments company is all that flourishing all that well. But let's keep going here. Market cap 35.6 billion. Got revenue of 21 billion. PE is really dropping. Analysts think there's a 139% discount. And I understand some people would say that's properly displayed. My brain works this way. The maximum discount I could possibly get on a stock is 100%, because at a 100% discount, it means that I'm literally being gifted the stock and everything's upside. At 139.8% means that the company's giving me, if it was a $100 stock, they're giving me $39 to take the stock. Not only am I getting a free share, they're giving me $39.83 along with it. So mathematically, like my model, I always, whether if it would show a number like this, I wouldn't show that number. I would actually, I have a if statement in there that says, well, the maximum, as I stated, is only 100%. But I understand the point here, that it's highly discounted. Okay. So this is the problem. No growth. That's a problem. What are our friends over at PayPal doing? Are those guys crashing and burning on the revenue line? Let's take a look. No, they're growing. And they did have a moment where it didn't look good. 1.2% growth, not good. But they're back to growing. Now, the market hasn't given them a whole lot of credit for that. Market's been beating them up. Didn't run over the stock with a truck like they ran over Fiserv. But maybe they threw the PayPal stock off the back of a truck moving at 45 miles an hour. So it's not a pretty picture either. So revenue growth, this is where the wheels came off. Let's look at the forecast. Are they going to grow? So it looks like this year, flat. Next year, tiny growth. Year after that, more growth. So this is like a business that's trying to repair itself. Now, I would say that a lot of investors are jumping out because they're probably thinking this isn't a 1 year problem. This is a big structural change to the way we're going to do fintech. And I think that the competition's pretty tough in this space, a lot of players. And I think that Fiserv is being left out of a lot of the growth in the market. So this one here would be tough to touch because it's risky. So they're not growing. How's their cash flow? $4.6 billion of cash. They're not growing. They're under trouble. If I multiply that by 10, I'd get to 46 billion minus debt. And here we got the next big problem with the company. Big debt. I don't like debt. Why do you have so much darn debt? Because I would have given you a valuation of 46 billion minus debt. So it brings you down to you're worth 17, 18 billion dollars. Your market cap is 35. I can't touch this stock. The debt is bad. Debt is horrible. This stock is untouchable. Can't touch it. And it's incredible to see the market was loving what they were doing previously. Like, what were they looking at? Okay. What do their margins look like? Let's take a look. And I'm going to go historically to try to see what was the market all excited about. So free cash flow. It was ticking higher, but it wasn't incredible. It was okay. In 2024, it was good. 5 billion, excuse me. The margins are good. See how they were growing their margins. So 60% is good. And then profit margin was good. So these numbers were good. I have to say that the market was being logical. But now when we look at the trailing 12 months, let's see how those numbers changed. So the margin's still there. The profit's still there. So yeah, maybe in like 2 years' time, this one will work. But I think for now, this is kind of Brandon investors' memory, like, whoa, this thing just got killed. And they don't pay a dividend. So I think it's going to be a while before this one moves again. I don't think it's discounted. I think it's priced. I actually think it's priced too high. So I think PayPal is a better option for me. It's just a better known commodity. It has more future products like Venmo. It really is a part of a lot of websites. So I'd rather be in PayPal. I think Fiserv is really risky. It's really gotten beat up. All right, so good to see you, Michael Anthony. Thanks for the comments on Super Micro. Benton. All right, so we got that one. So you're in Salesforce. Good to hear. You probably had a good Thursday, Friday on Salesforce. Went up nicely. Yeah, I mean, there's good stuff in Salesforce. I mean, software, excuse me. I think if we looked at 20 software stocks, I'd probably be like, I think 15 are buys because the space has been sold off because a lot of investment went into the data center and left what traditionally has been a super attractive business, which is software. I left it off on the side of the road. Like, hey, we're not interested. We got this shiny object called AI data centers. And it's got all our attention. We can't deal with businesses that do 80% gross margins, 30% net profit margin, are growing 10 to 20% and cranking out cash like they're a Federal Reserve office. We don't have time for that. We really have this shiny object in our focus. Well, now that shiny objects is becoming risky, you're seeing a lot of data center stocks sold off. investors are realizing, whoa, we're holding some pretty expensive stocks. Even Nvidia sold off in November. And now they're rotating back to software going, hey, remember this awesome space that we can make a lot of money at? Let's go back into software. Oklo had a pullback. How is that possible? Don't people understand that these guys have a terrific idea, but no revenue? Yeah, they had a good pullback and then a rally. Interesting. Year to date, up 93, excuse me. Look at that. Went real high, 174, came back down. This is a business with no revenue, but they've got a great idea, which is we're going to create these mini nuclear reactors, and they're going to be installed at a data center. Don't worry about the hazards of nuclear power. We got that. We're going to figure all that out. And maybe 5 years from now, we'll have a product. And maybe 5 years from now, we'll show how we're going to make money. And I'm like, whatever. Good luck with that. I'll be watching on the sidelines either to see the business explode or succeed, but my capital will not be at riding on your success or failure. So John Rogers, good to see you. Would love your thoughts on NextPower, formerly known as NextTracker. Yeah, if you buy a $5 super chat or you become a member, I could do that. And I appreciate you joining. If you, you'll see a lot of good analysis on the live stream. As always, I hope you find it interesting. And if you want to request a stock, it's a $5 super chat, or if you're a member, you get to request the stocks. Thanks again. All right, so we're going to keep moving. We're going to move to Poet. I think Fallsgrave wanted to look at Poet. Poet Technologies. They were down quite a bit on the 5th. Year to date, it's been a wild ride to see this stock. Up a lot and then down. So you're barely even on the stock. It's a small cap, 797. What do these guys do? Poet Technologies, together with its subsidiaries, designs, develops, manufactures, and sells semiconductor products and services for commercial applications in the United States, Canada, and Singapore. So they do semiconductor products, okay? The company offers photonic integrated packaging solutions based on the Poet Optical Interposer, a novel platform that allows the seamless integration of electronic and photonic devices onto a single chip using advanced wafer level semiconductor manufacturing techniques. Okay. They've been around for a while, 1972. So, of course, everybody's AI now. And these guys are our products. All right. Gemini, I need you to answer something for me. What end markets are Poet products used in? And is that the name of the company? Poet Technologies. And what I want to know is, you can't blame these companies that the hottest thing in semiconductor for the last 40 years is AI. So they want to say, hey, we're an AI company. Okay, cool. So this is what Gemini says. Poet Technologies products, which are high-speed optical engines and modules utilizing their patented optical interposer platform. Key end markets include artificial intelligence systems. They engage with pure play AI hardware company. Okay. Hyperscale data centers. That's very good. That's where the big growth is happening. So these two are good. especially this one. This hyperscale data centers, that's AWS, Microsoft, Azure, Google Cloud, CoreWeave. That's what we're talking about. Telecommunications, not so hot. This is not hot. Sensoring applications, not hot. This is LiDAR for cars. And I know that we have robo taxis, but the volumes are really low. And then high performance computing, that is hot. So they have some hot buttons. So these guys are legit. They're legitimately in a hot space. Okay. So now that we got that out of the way, why is the stock not rolling? If these guys are in a hot space, they should be super hot, melting lava hot. Well, this is why. They got like no revenue. So what is wrong with this picture? Why are we not seeing any revenue there? I don't believe it. Let me close some tabs here. So investors, let's see what they're. I'm going to go to their financials themselves and see if in fact. So here's their consolidated financial statements. It's hard to believe they're that little. Come on. Come on. So this is the balance sheet, I believe. Yep. So here we go. So revenue. So stock analysis had it wrong, but that's because I was probably looking at it. So this would be 760,000. So these are expressed in US dollars. No, stock analysis was correct. What's hard to believe is this is an actual number, right? I'm usually seeing numbers that are in the billions or in the millions. These are expressed in US dollars. This is the actual number. Their revenue for the quarter was $268,000 of revenue, but their expenses were operating expenses were 9 million. And then you add some other write-offs and they lost 17 million. So man, when are they going to make more revenue? All right. Well, this one's how did they get to a valuation of $797 million with that type of low revenue? So you see here, this is 762,000. The market cap is 797 million. So you're paying 1,000 times revenue. Okay. That's super expensive. If they were growing like crazy and they've been around since 1972. So like, what have you guys been doing for like 72 to now is 50 years? You guys been like going to the movies every day? How about kicking out some products? They started to go higher here when AI became this crazy shiny object. But boy, this business is, I don't get it. I don't want to invest in this business. Yeah. No thanks. These numbers are tiny. Looking at statistics, they probably issued out a bunch of stock to get their balance sheet propped up with some cash, which would have been smart. Yeah, this is not an investment I can touch. I think I took you through it, which is super small business. Their scale is incredibly tiny, but they've been around since 1972. So it's like, what am I missing here? They're caught up in a space technically that's pretty hot. Got it. But why aren't you selling like, let me show you what's hot and real and in similar spaces, right? So here's Astera Labs, 27 billion. These guys were not publicly traded before. they've been a really nice hot stock. 347, up 39.87 for the 1 year. But really, if you bought here, which is where I bought, you're up really nicely. But we're talking some real growth here. Okay. We're talking growth, 100% growth, $230 million of revenue. Okay. Not this less than $1 million of revenue stuff. And these guys didn't exist 10 years ago. I think they're kind of a newer company. 2017. So this is the real deal here. So this is data center related. Let's ask the same question of Gemini. I'm figuring out how to use AI in my analysis and where it helps me and where it's just like not good. And looking up this type of information is very useful because I used to go to their websites, look for this information. Now I'm like, so that's Gemini. It's good at this part. Astera Labs are primarily used in artificial intelligence and cloud infrastructure markets, where they provide essential high-speed, scalable connectivity solutions. Beautiful. Man, I love Astera Labs. It's a really volatile stock. Hang on. Put on your seatbelt. If you're going to wear a helmet, make sure you buckle the chin strap because there's going to be contact, people. There's going to be some good contact. It's going to go all over the place. It's going to test, your conviction on the stock. It's certainly been a wild one to be an owner in. But Poet is untouchable. Can't touch it. Don't want to touch it. Don't want to look at it. It is not a good situation there. All right. So we got to Oklo. Benton, disregard looking at KKR. Okay. Poet was too volatile for me. Yeah. Falls Grave. Good to see you. Thanks for asking. We got to look at, so when you look at what a great stock looks like, okay, this is a very good exercise. Look at Nvidia. This is what great looks like. Okay, this is an example of great. This is, I'm going to use the word perfect for the moment. It's December 7th, 2025. This is what you're supposed to look like if you grow your business and it becomes awesome. Not great, like phenomenal, like incredibly awesome. Okay, this is what it's supposed to look like. This is what great looks like. Okay, really high growth. You became massive. You're making a lot of profit. Your gross margins are 70%. Your profit is 53%. Incredible. And they make gobs of revenue and they get to keep more than half of it in profit. They get to keep more than 40% of it in cash. This is what great looks like. And it's good to look at a business where you're like, okay, they're caught up in one of these cycles of like, being run up. And that doesn't really show it. But like here, they went from less than $1 a share up to $6. So that's a 600% appreciation because of AI. This is what terrible looks like. And it's not growing. It's tiny. It's had plenty of years to grow. It's an example of like, okay, we got to be careful for these kind of situations. We got to go look for the next one that looks like this, or is kind of this is like a big, beautiful redwood growing in California. It's like 300 feet tall. It's majestic. It's awesome. This is a big, beautiful redwood forest tree. And we got to go find trees that maybe are just about 10, 20 feet tall that are going to be big, beautiful redwoods someday. And they're going to be super valuable and awesome, like Nvidia. Those are the ones we got to look at. We can't look at these that are not going to be very good at anytime soon. All right. So we got that. All right. Let's take a look at Chime. And then I'm going to take a quick break. So Chime, I think Bo wanted to look at Chime. He was saying that there might be a little, yeah, there's a rally going on, all right? So Chime Financial Technology provides digital consumer banking and payment solutions. It offers Chime, a banking application, does mobile banking. Okay. And these companies are probably going to do well going forward because these new tech companies, they don't like the old school banks. They really depend on net interest margin, which means you have depositors, they come in, um, and when you want to pay people that deposit money less than what you're lending at the rate. And just before I move off, hey Bo, we don't need comments like that. Poet's just a company, and yeah, maybe I shouldn't kind of say too many bad things about a company, but let's keep it positive. All right, so back to Chime. So Chime is a new generation company, and old school companies depended on like net interest margin. You have depositors, you pay them 2%, you lend out the money at 6, and that difference is your net interest margin. You made money. Instead, these new companies are like, well, we don't want that model. We just want like to charge transaction fees, and those transaction fees are really profitable. And that's in a way what Chime is doing, and it could be really profitable for them. So let's take a close look at these guys. All right. All right, overdraft fee. Okay, cool. Okay. And I say that because like the buy now, pay later stuff, it's just a transaction fee. They don't deal with like interest. They don't charge the customer interest. So let's take a look at the profitability. All right. So they're growing. That's good. Look at the gross profit. So gross profit, 87%. Beautiful. Beautiful. Operating margin, 6%. They're small. So for now, it's forgivable because their gross margin is so high. Okay. Free cash flow margin, a little low. Again, forgivable if they're growing, they have gross margin, which they do. And this is a new business, right? This is the quarterly. Let's go trailing 12 months. So that adds up the last 4 quarters. $2 billion in revenue, growing at 61%. I like that. High growth, good revenue line. And gross margin, 87%. I like the gross margin. So I like the gross margin. I'm okay with them not being profitable. Eventually, they're going to be profitable. But for now, I'm cool with it. And I'm cool with them not having free cash flow in gobs right now. Because what they're trying to do is they're trying to get market share. They're a small cap, $9 billion, revenue $2 billion. So when we look at the 1 year, this thing has really been thrown away with like last week's garbage. And maybe it shouldn't have. I love finding stocks that were taken out with the garbage that are worth a lot more, and then I make a lot of money. And anybody who picked it up is doing quite well. So is it going to keep going higher? Let's take a look. So far, I like what I'm seeing. Top line growth, high gross margins. I like that. So the forecast, we got 13 analysts covering it, 36% discount. Okay, so they're basing it on earnings per share. Right now, we're operating in this year, 2025, and then we've got 2026, 2027. So the growth isn't as fantastic at 20%, 17. It's good. It's just not like, whoa, 50%. So that looks okay. Be nice to see them grow faster. Okay, so I got that. I think I have a Chime valuation. Let me take a look here. Chime comes up, I would say, somewhat regularly. And so does Upstart and SoFi. I think SoFi is a little more mature than this one. Now, this one, it's not quite like a stock that I could give it a solid valuation because its earnings per share is so small, and I have to go way out to the 2027 number. So I think it's an interesting stock, like worth tracking and keeping an eye on. But for now, it's just not. It's not worth its valuation because it doesn't make enough money. In 2027, it's supposed to make 14 cents a share. So when we look at this guy, I think I was supposed to look here. All right, so 2027, it improved to 37 cents a share. But I have to go out like a year and a half to get there. But let's update that to 37. We're still priced too high. So I think Chime is going to trade higher on like good, like if the market's speaking good about fintech, which interest rates are dropping. That's a good thing for Chime. The stock's going to rally, but it's not going to rally on fundamentals. For me, I'd be out. I can't invest in that. I'd rather invest in like Upstart, which actually does have good valuation. There's other options in fintech that I can invest in that have fundamentals. SoFi, it's just not discounted, but it's priced a little too high, but it's priced better than Chime. And then when we look at new, it's discounted nicely. I'm buying into new holdings. This is more down in Brazil, but for me, Chime is just, it doesn't have enough value yet. It'll get there someday. And they keep growing. Thanks, Bo. Thanks for asking about Chime. Thanks for being on live streams regularly. And thanks for all your comments. All right. So let me do this, guys. I'm going to take a break and see if I can get something to drink. Let's see where crypto's trading. It's down a little bit. Well, from where it was earlier, it was riding kind of high up here. Now we're below $90,000 per Bitcoin. The reason I look at crypto is it's a little bit of a futures prediction. The futures flat, and I don't think Asia's open yet. Yeah, this is from Friday. Okay. So, all right, guys, I'm going to take a 10-minute break. I will be back at 6:10 Eastern. So let me put that up here. Cool. All right. If you'd like to talk stocks further, hang tight. I'll be back. Thanks, Bo, for the super chat. Let me know. Fill in the chat if you want me to look at other stocks. Pop them in there, and I will be back. What happened to my? There we go. All right. See you guys in a little bit. All right, guys, I am back, and I wanted to start with just a reminder. And I wanted to cover, and Paul, I see your comment. Give me 5 minutes, and I'm going to read your comment, and then I'm going to work on it. All right. So if you're an advanced member or a super investor member or a platinum investor member, you get access to this drive. It's the member content. And within it, you have a couple of things. First, the model that I use that you're very familiar with, that I use it just about every single valuation, which is this. This model here is on the shared folder. That's the model itself here. And it's used for all stocks that use discounted free cash flows and earnings per share. Then there's another model for banks, and that's in there too. And there's a copy of a retirement model if you want to build a retirement model. I've built my own, and I provided a copy. This is kind of an example of what I'm looking for in intrinsic value. And then the sheet that I'm going to open is this sheet here, VHI stock analysis. And that is what you would open here. And this is an ongoing repository of all the valuations that I have. And I'm going to go ahead and delete this guy. So as of right now, at this moment, this has been updated, and you would be able to see whatever stock you wanted to see. Let's say you're like, hey, what is the valuation on Meta? You go Control F, and let me get myself out of the way there. That doesn't look good. Let me try something else. Nope, that's not working. So give me a second here. Okay, cool. So if you hit Control F, it'll give you this view here. And then in that box, you can say, hey, I want to go look at Meta. And now you're looking at Meta. And look at the valuation. This is the date that I completed it on. And I think it's discounted. This updates real time. So based on Meta stock price, $673 is what it traded on Friday. You can look it up. Boom. Compare it to the value that I think the stock really is worth based on free cash flows and earnings per share. Let's say we looked earlier at Rigel. Boom. Here it is. You can look at Rigel. We updated it. You want to look at Nvidia. Boom. Go to Nvidia. Okay. And if you want a company listing of all the valuations I have, it's here, right? So you can see all the different valuations and kind of like the history that I complete on all these valuations. So this is available to advanced members. Just a quick tutorial. If you're already an advanced member, and if you haven't emailed me, please email me. I give you access to this drive. You'll have access to that. You have access to this valuation model. Here's the one that you use for typical companies like Meta, Nvidia, United Pacific. Use this one for banks. It's far more complicated. Use this one for real estate investment trust. So those are the tools I provide, and just a refresher. And if you haven't emailed me and you're a member, I'm going to put my email address in the chat. Please email me. I want you to get all the value that you can get from being a member, and email me and I'll get you set up. Okay. If you're a advanced member, super investor member, platinum investor member, please email me. I want to get you all the access that comes with your membership, and use these tools. You can come to the member calls, ask me questions. On live streams, you could ask me questions. There's some investors that are really active with these tools, and I'm glad, because that's part of the deal is, if you really want to learn something, try to teach it and you really learn it. Because, some things I take for granted. And when I go step by step, I'm like, hey, I could probably do that part better. Hey, I could probably understand this better. And it gives me an opportunity to do so. Trader Prad. Hello, sir. And Trader Prad is a trader. And he's been doing a lot of stuff on Polymarket, cool stuff. Check out his channel if you're interested in short-term trading and especially Polymarket. He's been really going to town on Polymarket. And I use Polymarket Lite as well as Kalshi. It's useful because it gives me like some predictions, especially around like earnings, right? I like going to Polymarket, and let's see what Polymarket's saying about Broadcom. Should have Broadcom on here. Broadcom's big. Are they gonna will Broadcom beat earnings? So I like looking at this, before the earnings, and chances are 99% chance they're going to beat. So it's kind of like that the stock is going to, that the company is going to announce ahead of where they're expected. But what's interesting, the stock has been rallying higher. So it's probably might be a case of they announce, they have good earnings, but the stock sells off. I don't know. It's good research. All right. So for older earning market. Here we go. Cool. There we go. Hey, that looks pretty slick. Thanks, Trader Prad. Yeah, so I use this kind of like as we near these earnings, right? Like which are the earnings I'm really following? I talked about Adobe. So what's Adobe going to do? Adobe's going to beat 93% chance. All right. And this is like, these are people laying down money, and it's not like some analyst that's got nothing riding on their opinion. This one's, there's money behind it. So anyway, thanks, Trader Pratt. Michael, so DLO and you, and then that's PAGS, it's Pago Seguro. Cool. Thanks for the comment. Yep. All right, cool. So covered that off. Now it looks like I missed one stock that I was supposed to cover, in that Shopify. I can come back to it. And then I wanted to get back to Paul's comment here. All right. So, Paul's comment, Victor, in the last stream, I saw you say you're buying new holdings. What makes this company attractive? Yeah, let's go into that. So, I've been in and out of the New Holdings, and New Holdings is a company that does financial services in Latin America, predominantly in Brazil. That's where they're headquartered. And I think Brazil might be the biggest economy that we're involved with here. Brazil, Mexico, Colombia, Cayman Islands, US. It offers spending solutions comprising of new credit, prepaid card, and a couple other different financial services. These guys, it's not like PayPal, it's different. It's financial services. Year to date, this stock's really worked. 5-year, it's worked. If you buy at the right times, you're doing great with the stock. It's a substantial market cap, 80.9 billion. So it's investors are buying into the stock. It's not like a tiny little cap that's super risky down in Latin America. And forward P of 21. Analysts think it's discounted a little bit by 5%. It's had a nice rally since its earnings call. So they announced here. November wasn't a rally month, right? We had a little bit of a pullback here or there. But after we got through some rough waters, this thing really went up higher. And it gave me a chance to buy shares right after their earnings. So I'm not going to complain about that. Bought some shares and saw my shares go up. Now, what do I like about this company? Well, I'm like a broken record. Sorry. Revenue growth, 36% in the quarter. I like 36% revenue growth. That's on a pretty good size number. This is in US dollars, almost $2 billion in the quarter. So for a year, it's like $8 billion of overall revenue. Growing it by 36% is impressive. So that looks good. So in the quarter, revenue is good. Profit margin, they're in financial services. So 39.76%, back to that whole transaction. They charge transactions versus, trying to make net interest margin. And I think that's more advantageous, by the way. Banks hate these companies because it takes this type of revenue away from banks, and these guys are taking the best part of financial services away from the banks. We look at the forecast. 9 analysts cover these guys. They're expecting continued growth. So I like the existing growth. I like the growth ahead. Next year, 24, then followed by 17. The profits are going to expand. So I like that. And when I look at their valuation, which let's look at what you guys could see, 24/7. We don't have to go to my version. We can go to the version that you guys have. And look, we've got a couple guys in here already. Kurt's in there, Zach, Mike. We got a bunch of guys in there. All right. So we're going to look at new holdings. And new holdings, I only value based on earnings per share, 38% discount. So I'm getting a growing business that's priced right, that has momentum. It's been invested into by a good number of investors. And the thing that makes me uncomfortable is it's out of my home country. And down in Brazil, Brazil could be a little risky, but I increased the discount rate. So I get a higher rate of return. If everything works out, I get a higher rate of return with new holdings. I'm discounting the numbers by a higher discount rate. So it gives me, I think, a risk-adjusted rate of appreciation. So that answers the question of why do I like new holdings and why am I buying it? And I did catch a good price on new holdings. I'm going to go here because I like the charting here. So if we look at the monthly, they announced the stock was under a little bit of pressure, no problem. Was able to buy some shares, and then it took off. So I'm up a little bit, and I was in new holdings before. At times, I de-risk my portfolio, or maybe I rotate certain stocks out of my portfolio. I had done well with the stock. I sold at a gain, went away for a while, and then I came back. With the earnings that they just had, those earnings were really good. So that compelled me to get back into the stock. So that's my answer to your question there. Thanks, Paul. And then Bo, I still owe you, I think, a stock if you want me to look at it. A stock. I think. Thanks for the super chat. Appreciate it. And we're going to hit Shopify. Shopify is a software company, and it's a stock that's done well overall. This might be the most valuable Canadian company that's listed publicly. They are what's their market cap? 209 billion. Let me ask Gemini. Gemini knows everything. So what is the most valuable publicly traded Canadian company? The Royal Bank of Canada. Number 2 is Shopify. Okay. So I was off. And then Enbridge is up there. So those banks are pretty valuable up in Canada. Brookfield Corporation's up there. But Shopify, you can see it's a valuable company. And it's a big success story. I like Shopify for what they're doing. I've never really been an investor because I'm going to show you their fundamentals. And there's some things I like, some things I don't like. And right now in software, there's really good companies that I could buy, really good valuations. So they're big. They've done well this year, and they've done well for a while, especially coming out of 2022. You could have bought Shopify for $27 a share and taken that beautiful ride up. Isn't that a beautiful chart there? And so this stock here, P ratio, I don't like, 96.8. It's growing. I get it. But they're growing at 25%. I can buy Meta. It's growing at 26%. My P ratio is 25. And it's more profitable than Shopify. Well, why am I going to pay 96 PE when I can buy Meta for 26? So the P ratio is a little high. Now let's take a look at trailing 12 months. Remember, I like revenue growth. Revenue growth is there. Okay, that's good. One box is checked on my desirability. Gross margins 48.7. Now this is a software play, but these guys do a lot of their own hosting. They run their own infrastructure. And that is what keeps their margin lower than a typical software company. Like Adobe's 89% gross margins. We saw Nvidia was at 70. These guys are at 48. That's not a bad gross margin number, but it's not as high as these really cool companies. Meta's 85% gross margins. And then their profit margin 16.6. Again, not bad, but you're not up there with the greats. Nvidia is at 53. Try that one up on for size. 53. Their profit margin's higher than your gross margin. Incredible. So these numbers are okay, but they're not great. The revenue number is good, but the rest of their valuation is dependent on how much money are we going to make. They're going to grow, but are we going to make a lot of money? The analyst, Shopify deserves credit because they carved out a good market for themselves. If you want to create a business, have an awesome website, that website sells online. I think they have plugins to be able to list on multiple platforms like Amazon and other platforms. You can be all over social. All that stuff's great. But you can see that some analysts are also on the side of, hey, this thing might be too expensive. In fact, they think on average that it's priced right. And right now I can buy software stocks that are really discounted. Looking forward, next year they're going to grow at 23, then 21, then 21. Profit's going to expand, but their darn PE ratio is going to stay way up there. Again, I can find some really good looking profitable businesses with low PEs. Let me show you one. Adobe announcing this week. And these guys are not growing like Shopify, only 10.6. That's a pretty good growth rate. But when you look at their profitability, 89% gross margins. Profit margin, 30%. Gross their free cash flow margin, 41%. Those are awesome numbers. When you look at what analysts are saying, they think it's discounted by 31, and my discount on Adobe is even better because I look at cash flow. So these guys, really big success story. Awesome. But I'm not investing in companies that I'm a fan of. I'm investing in companies that are priced right, that can make me really good appreciation. And right now, I think Shopify's priced too expensive. Let's take a look at Shopify, the valuation. I'm going to close this one out because I'm going to confuse myself. And then I'm going to start doing things on that sheet that I shouldn't be. All right, so let's go over to Shopify. This is kind of like the master sheet. I'm the only one that has access. So you see that before I update it, I'm underwater by 45%. I think the stock's priced 45% too high. It's been a stock that's been going up. And again, these guys deserve a lot of credit. I think they're a really neat company. But there's a lot of investors that see it and just look at that top line. They're like, oh, that's great growth. They're right. But not all businesses are created equal. All right, so I'm going to update some free cash flow numbers. Take a look here. And their free cash flow for the trailing 12 months is $1.9 billion. That wasn't too far off. And they're growing better than that. So I do need to update the growth rate. I'm going to update it to 30 because they were growing at 30%. So we can update that number. Now, I showed you the growth numbers going forward. They were going to be like 22, 21. So we're going to go with 22 here. All right. So the intrinsic value of cash going forward is $104 billion. Now I can add cash and take away debt. The cash on the balance sheet is $6.35 billion. They do have a little bit of debt here, $1.12 billion. So you see that if I compare the value of their cash in the future, discounted to today's value, the stock price is 29% too high. Okay. And earnings per share, let's update that number based on the best number we have for 2026. And that number is $1.87. Not too bad from where we were at before. I'll give them a P at 36 because they're a growing company. This growth rate of 20% is fine. So I'm 36% off. I think Shopify is priced 36% too high. Now I can buy Wix, which is a e-commerce company, website company, 61% discount. Now let's compare these two. So one, our friends here at Shopify have a market cap of 154 billion. Is that correct? Let me double check that. It should be 209 billion. So my share count is off. Give me a second here. So let's go find. Yeah, it's even worse because the share count was wrong, but the valuation's even worse. So comparing Shopify versus Wix, they're a little different, but they're both in the website e-commerce business. This one's $196 billion market cap. This one's only $5 billion market cap. And the rate of cash flow, you're earning 1/4 as much cash from Wix, but the stock price, the market cap, Shopify is 35 times more market cap, but it only produces 4 times more cash flow. So I could produce way more cash flow for every $1 billion of market cap from Wix. It's a much better investment for me. I was in Wix. I sold. I shouldn't have done it because it's been rallying lately. And people that stayed in it are in the Discord on this channel, and they've told me about it, which I'm happy for them. Lately, it rallied from here to here. So we'll see how high Wix goes. I think it's going to do well because software, again, has been beaten down. And these guys are a pretty solid little company. So Shopify is a sell for me. I just explained the reasons for it. Again, it's a good company, good business, been successful. It's just too expensive. I got to get the right pricing. How I buy a stock is really important. It's kind of easy to find good businesses. Shopify is a good business. They're growing. You can find Microsoft. Hey, they've been a really good business. Apple. All right, cool. But when can I get a stock price that's really low compared to the value of that business? And I could take advantage of it. Like recently, Meta, it's really sold off, priced really well. I'm off to the races. I want really good pricing. I want my cake and I want to eat it too. I want a very desirable business at a discount. I'll buy it at the right time and then see my capital go up in value. All right. So I just knocked out Shopify, and sorry that I missed it on my first go around, but I'm glad I caught it before we moved on. All right. So we got through that. So GitLab, I can cover that if you'd like to sponsor Super Chat or become a member. And then we've got San Francisco. Hello from France. Hey. Comment allez-vous? I don't know any French. That's about it. But very nice to have you. Thanks for joining. It's great to have you on the stream. All right. Anything going on here with the stock market here? So I covered the update to the valuation. Check. Covered all the stocks that were requested. Check. Very good. Let's see what we got with the futures market. Nothing really. And then Asia will open up in a couple of hours. So we're good there too. All right. So I am watching the Rams play the Arizona Cardinals. It's a one-sided game. The Rams have this game handled. The earlier games were fantastic. Buffalo and the Bengals put on a show. And so the other game was also very competitive, which was the Steelers versus the Ravens. And the Steelers took that one, and they took it in Baltimore. So I think the Steelers now lead their division and will probably be in the driver's seat to make the playoffs. All right, so we got that handled. Any other request? I'm going to check my social and see if there's any questions that have been asked that I could probably bring them onto this stream. And it looks like and just to let you know, for advanced members, I released a video on the best and worst companies within let me try to find that video for you. Biotech. So I just released this video for you guys for advanced, super, and platinum members. I really try to go deep into each company. Some of these companies have been really coming up quite Investors often. Have been making a lot of money. I know Regeneron's come up quite a bit. Vertex. Genmab came up quite a bit this past week. It's been really going up. So I'm like, well, where there's smoke, there's fire. So I analyzed these 10 companies and, kind of gave you a sense of valuations and where maybe some stocks are overheated, some are underheated. So take a look. Take a look. If you're an advanced member, take a look. I think it'll be worth your time. I hope you find it interesting. That was the video of the day. It took me a couple of days to complete it because I covered 10 companies. So the research took me a while. And I hope you, again, find it interesting. So that's going on with the channel. This week, I'll be streaming tomorrow morning with Daryl at 9 a.m. Eastern. And if you want to kind of get the combo of fundamental analysis on a stock right before the market opens and during the market open, that's when Daryl and I cover it. I think he does a fantastic job. I bring my stocks and have him look at the charts because I think what he does is very good. Helps me kind of establish a good entry point into a stock, or maybe some stocks that I own, I think they're above their intrinsic value. And I just want to see, are the stocks setting up to sell off? And I think he covers that really well. So that is tomorrow morning, 9 a.m. Eastern, 6 a.m. Pacific. And this week I'll stream on Tuesday afternoon and maybe Wednesday and Thursday. I'm going to go 3 days in a row because we have those big earnings. So I thought, hey, let me try to stream for the evening crew. That way I could take some questions around Adobe, around Broadcom, the stocks that are moving up or down this week. And overall, I think we are going to see a positive December. That's my best guess. And I think for 2026, it should be another appreciating year. 2025, I think at this point, how high is the market? Let's take a look. So US. So year to date, the S&P is up 16.8. That's good. And if it goes up a little higher, maybe to 17.5 or so, that'd be probably what I expect. But if you look up the last 3 years, right, just great appreciation. 76% over 3 years. I don't think anybody's complaining. That's great on the S&P. The NASDAQ is even better. So this goes to show, right? Retail investors are empowering themselves to build wealth. If you're in the NASDAQ, these are the stocks that are technology stocks, even other sectors that are high growth stocks and financials and healthcare. They're in the NASDAQ. And the NASDAQ would have more than doubled your money over the last 3 years. So retail investors, individual investors that are making themselves more intelligent, more capable, learning, investing, building the skills to grow. That's the investor that's making a lot of money. And this year, 2025, retail investors, we are beating the institutional investors. And I think that's going to be a common theme because I think retail investors, they don't have a huge advantage on us. We're the ones that are putting in the sweat equity on stocks. We're the ones looking at Genmab, Alibaba, and stuff like that. So looks like Dwayne is on. How you doing, Dwayne? Genmab or Baba for 2026? Oh, man, come on. I love all my children and I love all my stocks. But if I had to pick one, and I think I typed that wrong. So Genmab's already kind of made a pretty good move here in 2025. That's a pretty good move there. And if we look at Alibaba has a long appreciation cycle coming. But even though Genmab's been a freaking rock star, Alibaba is a rock band. 86%, 52%. And when you look at the strategic position of Alibaba, Alibaba is the e-commerce giant in Asia, big, huge economy. They're also the biggest cloud infrastructure player in Asia, huge economy. So I think Alibaba is going to be a $1 trillion market cap company. And I think Genmab is going to be a good winner, but it comes with a lot more risk. So my answer to you, sir, is Alibaba. I own a little bit of Genmab, like $3,000. I own $100,000 of Alibaba, and I'm still buying Alibaba. So that's where my conviction is. That's where my sentiment is. Alibaba. Let's take a look at the valuations that I have on those two. So Alibaba, I think, is still discounted by 34%, even though it's had a really nice rise. I think it continues to add and appreciate to its value because it keeps getting bigger. And I think this stock, even though it's at $353 billion in market cap now, it's going towards becoming a $1 trillion market cap company, which would mean that it could triple from this point, literally, over the next couple of years. I think it's going to go there. It has some tailwinds as Asia goes and it grows and wants to build large language models and technology platforms and so forth. Alibaba is going to take a lot of that revenue. And Alibaba also does business in other parts of the world, like other parts of Asia, India, Middle East, Latin America, Africa, because it provides a very lower cost proposition versus AWS, Azure, and Google Cloud. So that's my answer to you, sir. Good to see you. And again, diversification is important. You know, you put all your eggs in one basket, may work out really well, but if one of your eggs goes bad, it doesn't work out for you. When you diversify, you're kind of spreading the risk. So that's why I would still like to have some healthcare stocks as well as some technology stocks. And Alibaba is officially an e-commerce consumer discretionary stock. So good question. What other questions you guys have? The football game's like pretty much done with because the Rams are going to win this one. They got it locked up. So what questions would you guys like to ask? While you guys think about it. So I talked about like the membership to the YouTube channel. It's going really well. It's awesome to get to know you guys better and the member calls and live streams and just continue to like improve. I improve as an investor. I think I'm sharing content that's interesting, help you improve your knowledge as well as your knowledge within a specific stock. And there's 4 levels that you can be a member. As simple as $10 a month. You can come on live streams, request a stock. We look at it, analyze it, talk about it. You want access to that shared folder I talked about with the tools, $25 a month. Plus you get invited to a member call and you get invited to the Discord. $100 a month. This is for somebody who really wants to go even further. 30-minute call once a month. I also provide super investor videos where I'm going through my trades a couple times a week. And then also what I started to do is I have a video where I put forward my 4 stocks that I have the highest conviction on leading into next week. And I'm going to update that video and share my research behind each stock that I list out. And then the highest levels for somebody who really wants a lot of research done, $200 a month. And you give me 3 stocks. I do all the research and you get everything else. When you go up these levels, when you're an advanced member, you can do everything that a value member also does. When you're a super investor, you get all the perks of the 2 previous levels, and then platinum gets all the perks listed. So take a look, consider it. I think it's a good thing. So where do you see Uber compared to Baba? That's a good question. So let's talk about it. So I think that Uber and Alibaba, they're in different markets. I like them both. I want to accumulate both. I have high conviction for both. They don't really compete against each other. Not that they would have to, like, or not that that kind of changes anything. I have so Uber. I've gotten to know Uber quite well, and their biggest market's here where I live, so that's good. But they're growing internationally. I think Uber is a good stock, but I have to say that Alibaba actually has a a business that's stronger and can weather potentially a bad economy for one business. Let's say the e-commerce business isn't doing all that great. Their cloud business can pick up the slack. They also have this huge fintech business, Alipay, that could pick up the slack. Uber is kind of two things, right? It's mobility, ride hailing, and it's food delivery. And I think the two are different, but I think you could have maybe a change or more competition, especially around food delivery, that could cause Uber revenues to not be as good as they can be. So I would kind of give the nod to Alibaba again against Uber. But these two are pretty darn close. And I have high conviction for Uber. It's a big investment. And it's a big investment in Alibaba. If you look at the performance, I think Alibaba outperformed Uber. And that's the other thing that you got to think about with Alibaba is that for a while the market just really didn't buy Chinese stocks. So coming out of 21, Alibaba sold off just harshly, right? Just really, really bad. And picking up shares at ideal positions in the market was a really good idea. Okay. So this beatdown that Alibaba took is part of the opportunity because this beatdown brought down the stock price a lot. Uber, I don't think was as beat down as Alibaba over the 5-year. You see how coming out of the highs of 2021, this one was beat down pretty good, but it's roared back. I mean, Uber's just been fantastic. And so I think there's better upside on Alibaba. And again, I have conviction for both. I'm not selling one share of Uber. I'm not selling one share of Alibaba. But if I was going to have to state which one do I still think is like a little better, I would say, Alibaba is probably setting up to be better. It's also the dominant Chinese stock, right? It's that, maybe two others are pretty dominant out there. But here, head to head for 2025, Alibaba outperformed, and I think they're going to keep outperforming. So good stocks, both of them. All right, guys. Well, I'm going to go ahead and wrap up the show. Thank you so much for tuning in. I appreciate all the questions. I appreciate the super chats, and let's do it again. I'll be back next weekend. In between now and then, in the mornings with Daryl, Monday, Wednesday, Friday, and then in the evenings, I'll probably do Tuesday, Wednesday, Thursday this week, and I'll try to get the notices out so you know when it's going to happen. So that is it, folks. You guys have a terrific rest of your Sunday. Good luck with your investments this week. Let's hope that the market trades higher, makes our portfolios worth more. That'll be fun. We start rallying toward the end of the year. Be great. Be fun. Then we'll figure out how we're going to beat the market again 2026. You really should be thinking about it now. It's a good idea to do some portfolio kind of analysis. I did that for myself this morning. Got a couple of ideas to make my portfolio a little stronger, a little better, a little faster. So I could outperform the S&P again next year by a broad margin. So that is it, folks. Have a good night. Thanks again.